Hey, welcome back. I want to provide an update for you guys regarding foreclosures on a national level. And this video is going to be a little bit different compared to my previous updates. I tend to make this video every month. I'm going to compare the figures we're seeing this year, how they compare to pre-COVID levels going back to the year of 2014. It's actually two reports I want to share in today's video. The first one is this right here from ATTOM or ATOM. They look at foreclosure activity in the first half this year, January through June so far this year. This was just posted last week on July 11th. So according to them, there was a total of 177,431 U.S. properties with foreclosure filings. That's defined by default notices, scheduled auctions, or bank repos in the first 6 months of 2024. That figure is down 4.4% from the same time frame 1 year ago, but up by 7.8% from the same time frame 2 years ago. Now, here's one thing I noted, which I'll add right here. This, by the way, is based on year-to-date figures, January through June this year. So I actually looked at the average from 2014 through 2019. There was 472,000 foreclosure filings on average. This year, same time frame, only 177,000. So therefore, so far this year, it's down 63% compared to the average January through June change from 2014 through 2019. So big picture, we're down 4.4% compared to last year at this time, but also we're down 63% looking at historical averages as well. On top of that, there was approximately 10 times more foreclosures at the peak of 2010. Absolutely insane. Here's a fantastic snapshot looking at foreclosure activities. This is January through June each and every year going back to 2008. Right now, again, 177,000. So this year so far, again, 177,000 foreclosures. Last year's time, we had 185,000. Looking at pre-COVID levels, I'm not including 2013. That was basically the recovery after the Great Recession. So only looking at 2014 through 2019, based on my dumb math, approximately 472,000 on average for those years, much less than the 177,000 so far this year. Therefore, big picture, we have fewer foreclosures this year compared to last year. On top of that, we have approximately 63% less compared to long-term averages going back to 2014 as well. Not only that, here is another report as well. This is from HUD. This is their Housing Market Indicators Monthly Update posted on June 24th, or for their report posted in for the month of June. This report, though, covers the month of May, the most recent report we have from HUD. So I want to share this because I want to provide analysis looking at this year compared to the same time frame in 2018. So this May, looking at overall mortgage delinquency rates, prime mortgages we're only at 1.3% of all loans. These are basically people who have fantastic credit scores, putting a hefty down payment, the best mortgages or best borrowers for these mortgages. Subprime, 15.3% of all subprime mortgages are delinquent right now. FHA loans at 10%. Again, this is May of 2024. Look at 2018 though. This is mortgage delinquencies again. Prime mortgages, 1.8%. So June, or I should say May of 2018, prime mortgages at 1.9%. Now it's at 1.3%. Subprime, 2018, 21.9%. This year, down to 15.3%. The only uptick was actually FHA loans. Back in 2018, it was at 8% were late on paying their mortgages, whereas in this year, it's at 10%. But prime and subprime loans at much lower rates compared to 2018. On top of that, look at 2018 for seriously delinquent mortgages. These are people who are at least 90 days or more late on paying their payment. So prime mortgages, 238,000, these are in thousands of units, 238,000 loans that are prime were very late on paying their payments. Compare that to right now, only 199,000. 2018 for subprime, a giant increase, or not, subprime mortgages in 2018, 185,000. Subprime mortgages in 2018, 185,000 loans. This year, only 23,000. FHA loans in 2018, 349,000 were seriously delinquent. Again, at least 90 days or more past due. Now, only 271,000. So to summarize this, back in May of 2018, there was approximately 772 mortgages that were at least 90 days or more past due on paying their payment. Now, fast forward to May of 2024, only 493,000 were very late. Therefore, there's 279,000 fewer compared to May of 2018, and that represents a decrease of 36%. So overall, not only are the rates much less compared to the same time frame back in May of 2018, but also the total amount of people who are very late aren't paying their payments as well, much less than compared to 2018 as well right now. Also, have a look at this. There was just under 2.5 million borrowers who were underwater on their mortgages. In other words, they owe more than their house is worth back in the first quarter of 2018. So nearly 2.5 million people who are basically underwater on their loans. Now, fast forward to the first quarter of 2024, there was 997,000. I should say that's just under 1 million, but that's approximately 1.5 million compared to the same time frame in 2018. But wait, there's more. Let's look at foreclosure actions. Foreclosure starts, that's basically the beginning phase in the foreclosure process of a homeowner. They're late on their payment, they're very late on their payment, and the lender has basically started the foreclosure process. So looking at May of 2018, there was 33,600 foreclosure starts. Looking at May of 2024, only 22,600. 2018, looking at foreclosure completions. These are basically homes that got foreclosed on. There was 21,300. Now, only 3,400. Short sales, 3,500 versus only 2,300 this year. Also, REO sales, these are foreclosures in which the lender hired an agent to sell the house. It often gets listed on the multiple listing service, but there was 13,300 back in April of 2018. Now, this April, only 4,800. So big picture, we have overall delinquency rates much less than 2018. Overall, people who are very late on paying their loans at much lower levels compared to 2018. Also, people who are underwater, much less than 2018 as well as foreclosure starts, completions, short sales, and REOs. And one more thing I want to add regarding this is that when comparing this year compared to 2018, look at the national homeownership rate. The first quarter this year, that rate was at 65.6% of people own houses. So just under 66%. During the same time frame in 2018, 64.2%. So therefore, delinquencies, homeowners underwater, and foreclosures, as well as short sales, are down from 2018 despite a higher homeownership rate. On top of that, not only is the rate higher, but there's likely more households in America this year compared to 2018 as well. And by the way, here is that website I found this on. Again, I'll provide a link in the video description below for this. But if you guys want, you can look at 2019, 2017, and potentially before that. So if you guys actually look at these reports that I did not cover in today's video, then please let me comment below with your thoughts and also your findings as well. I'm only looking at May of 2018 compared to now. I want to look at pre-COVID levels. In any case, let's get back to Adam's report here. It says, in contrast to the first half of 2023, foreclosure activity across the US experienced a decrease in the first half of 2024, as I explained. In addition, US foreclosure starts also decreased by 3% in the first 6 months this year. These shifts could suggest a potential stabilization in the housing market. However, monitoring those evolving patterns remains crucial to understanding the full impact on the real estate sector. Now, I just kind of want to talk about, I don't want to say like everything's rosy, we're just fine, there's nothing to be concerned about, because there is some concerning things that I am following that you guys should be aware of as well. So here's a few things I want to talk about here. This is consumer debt for credit card balances. This is according to Fred from the Federal Reserve System, and as of July 8th. So as of July 8th, the report, which covers the month of May, there was just under or just over $1.3 trillion of credit card debt right now. And that, by the way, is an all-time record high. Look at the 5-year chart, $1.3 trillion, the highest levels on record, which goes back all the way until the late 1960s. On top of that, looking at pre-COVID levels, we didn't get above 1.2 million or 1.2 trillion. Now we're at a whopping $1.3 trillion in credit card balances on national level. Now that is concerning, right? Here's what's also very concerning as well. The overall delinquency rate of credit card balances as well. That right now, which is for the first quarter of 2024, 3.16%. That, my friends, is the highest rate we've had going back to Q4 of 2011. On top of that, looking at pre-pandemic levels, the range was in the range of about 2.5 to around 2.7. Now we're at 3.16%. So overall, a high rate of late payments for credit card balances. But again, not nearly as high compared to the peak set in Q2 of 2009. The rate then just under 6.8%. Now we're at just over 3%. So not only do we have high credit card balances, but also we have a high rate of late payments as well. And on top of that, looking at the overall savings rate for everyday Americans, just posted on June 28th, this covers the month of May this year, the personal savings rate only 3.9%. Looking at pre-COVID levels, so for example, December of 2019, it was at 6.4%. Every single month from, when was this? From going back to July of 2016 through the end of 2019, that rate was over 5%, at or above 5%. Now it's only 3.9%. So people spending money, but not saving it on a national level. Now, what we're not seeing though is a huge increase on foreclosures, as I shared with you guys in that report from Adam, because the overall delinquency rate for single family houses, this is according to the Fed again, and this covers Q1 of 2024, is only at 1.71%. Looking at pre-pandemic levels, we're at around 2.3 to around 2.6%. Also zooming in over the past 10 years at 1.71%. This is much lower compared to Q1 of 2014 when the rate was at 7.77%. So overall, we have people spending money. We have a lot of people who are late on paying their credit card balances, but overall, we're not seeing foreclosure activity increase by any means. We're still at very, very, very low levels right now. Now, what I'm also focusing is on this right here, because this could all change if unemployment spikes. So the unemployment rate set in June this year is at 4.1%. This, in fact, is actually the highest unemployment rate we've had going back to November of 2021. And that is this right here, November 2024. And back then, the unemployment rate on a national level was also 4.1%. Looking at the unemployment rate going back to the year of 2000, though, right before the Great Recession, the unemployment rate was hovering around 4.4 to around 5%. Now, again, we're only at 4.1%. It's also much lower compared to the peak right after the Great Recession at 9.9%. So that's basically double the rate we're having right now. And by the way, if you guys notice this right here, the unemployment rate spiked back in April of 2020 at 14.8%. But of course, that was more impacted by COVID lockdowns than anything else. All right, changing gears slightly here, I want to talk about a new report from ICE as well. This is formerly Black Knight, just posted a few days ago. So the national delinquency rate for mortgages fell 6 basis points year over year to 3.04% in May, the second lowest point on record, behind only March of 2023 when the rate was at 2.92%. So overall, the national mortgage delinquency rate at very, very low levels, at least for the month of May. This also marks the 5th consecutive monthly improvement or decrease in serious delinquencies as well. Again, at least 90 days or more late on their payment. So overall, the rate is down to the second lowest on record. On top of that, overall, serious delinquencies also going down as well. It says while 31% of serious delinquencies are no longer protected from foreclosure, the highest share since forbearance plans were broadly introduced in early 2020. Back in, I think it was in March of 2020, we had the introduction of the CARES Act, which had all these moratoriums, and also enacted basically mortgage forbearance programs as well. So that only equates to about 126,000 at-risk mortgages, which is still near the bottom of the 124,000 to 176,000 range we've seen in recent years. That also agrees to my math right here, because it says of the 410,000 loans that are very late on paying their loans or their payment, 69% of those remain protected from foreclosure. Those are from forbearance at 31%, loss mitigation at 24%, or bankruptcy at 15%. So therefore, that leaves only 127,000 that are not protected. For context, there's just under 1 million houses for sale, according to Redfin, over the previous 1 month. I think it was around 970,000. So therefore, the amount of potential foreclosures is a very small fraction of the total number of houses actually for sale right now. Therefore, if we were to assume that 127,000 loans were basically get foreclosed on, this is likely not going to negatively impact our housing market because it's a small sliver of the amount of houses for sale. Again, just under 1 million houses for sale right now, but only 127,000 at risk of being foreclosed on right now. If you guys want to see the housing market crash or for home prices to absolutely tank, you need to see supply far outpace demand. And based on the data we have today, that glut of supply is not coming from a foreclosure crisis by any means. ICE also provided this as well. Here's a chart looking at the overall national mortgage delinquency of first lien mortgages. In other words, the loan you use to buy your house, basically excluding HELOCs and home equity loan products. Anyways, the overall rate, I should say the average from 2000 through 2005, obviously right before the Great Recession, was at 4.13%. Now, in May, it's only at 3.04%. So far below the run-up prior to the Great Recession. Also, for context's sake, at 3.04%, much less than the nearly 11% rate we had back in 2010. And with that said, if you guys got any value out of today's video, please hit the like button. This video took me hours to make with all the research involved. So hope you guys got a lot of value out of today's video. Of course, if you guys are still watching today's video, please hit the like button. I greatly appreciate that. Also, consider subscribing as well. I post frequent housing market updates so you guys can be more informed. With that said, hope you guys have an awesome day. I look forward to seeing you in the next video.